new rental mortgage rules in Canada kick in by January 2026, and a lot of investors are panicking. But here's the truth. If you are investing in Toronto, you're probably not the target. And here's why. Canada's mortgage regulator, OSFI, has a new rule that creates a new category called the IPRRE, Income Producing Residential Real Estate. A mortgage is flagged as IPRRE if more than half of the income used to qualify comes from the property's rents. Now, once it's flagged, the bank has to treat it as higher risk. And that means banks have to hold more capital in order to lend to you, which makes the loan less profitable for the banks. For you, that translates to higher rates and tighter terms for the deal to still make sense for them. On top of that, there's no double counting. So if you are already using income to qualify for one property, you cannot recycle that same income for the next property. So here's how it looks like in practice. On the West Coast, for example, you might be able to buy a $300,000 house that generates around $2,400 in qualifying rents per month, or $29,000 a year. Now, if your salary is only $20,000 a year, most of the income that the bank is using to qualify for the property is from the property's rents itself. And this will be considered an IPRRE loan. So if you had another property and you already used your salary to service that first property's mortgage, you cannot reuse it here. So what this does is it does make scaling harder. Now, Toronto is a completely different story. Take a $1 million house. Now, to get this property flagged as an IPRRE in Toronto, you would need more than $7,800 a month in qualifying rents, basically a 7.5% cap rate. And this simply doesn't exist here in Toronto, which means that most Toronto investment properties would probably not fall under the IPRRE in the first place. So, based on this, who is OSFI actually targeting? Mainly portfolios being scaled almost entirely off of rents, like Calgary, Edmonton, Halifax, or even Montreal. These are markets with higher cap rates, lower long-term price growth, and rental supply growing much, much faster than demand, and OSFI really wants to cool this down. Toronto investors are actually not their target. Here, you would need strong income to qualify in the first place, and the strategy is more well-balanced between appreciation, rent growth, and value add lift, not just pure cash flow to get into owning real estate. OSFI knows investors are needed in Toronto to keep building supply where demand is real, so I would say it's more likely that these OSFI rules won't stop you from scaling the way you already have been investing here in Toronto. Now, a more balanced strategy isn't just about avoiding OSFI's crackdown. It also lowers your risk too. So if you do want to scale strategically in Toronto's multiplex space the right way with strategies built on strong fundamentals and OSFI-friendly mortgages, just book a call with us and let's map out how you can grow your portfolio. At Elevate Realty, we're not just a real estate sales brokerage. We're advisors, planners, and coaches specializing in Toronto's multiplex space. We can help you spot the right opportunities, run the numbers, negotiate and buy the best options for your plan renovations with you, place tenants for you, and eventually manage your property long-term so that you can focus on building your wealth. Now, if you are serious about investing in Toronto, just head over to this link here and book a free strategy call with us today.